Good afternoon. Welcome to CNBC-TV18's Mumbai Newsroom. I'm Sonal Bhutra. With me, as always, is Pavitra Parekh. You're watching MF Corner. So, Pavitra, we discuss a lot of topics today. It's going to be an interesting one again. So, we are going to be talking about value investing. What makes this category very interesting in comparison to, say, something like a growth funds? What would Contra investing look like? And we'll discuss the other categories, considering that we're so close to record high as well. Yeah. Let's talk about ELSS funds, mid-cap and small caps that have done really well. Yeah. And let's get going.
We have lots to discuss clearly, so let's get cracking. We have with us Daylynn Pinto, who's Senior Fund Manager Equities at Bandhan Asset Management Company. Daylynn, thanks a lot for being with us today and taking out the time for this show. You know, my first question is exactly that Sonal was mentioning value investing. That is one of the investing styles that you are very well known for. For the sake of our viewers, you want to take us through what value investing really is and how does it really work for someone who's very new and, you know, looking at markets perhaps for the first time?
Sure. So, good afternoon, and thank you for having me on the show. So, I think, for us, the mainstay of value investing really lies in buying businesses where probably the current micro environment is not in favor of the company. So, basically, companies that are kind of out of flavor at this point. But to us, therein lies the opportunity because we believe that substantial alpha generation really takes place, when you get into these companies at distressed values. And as the micro environment improves for that particular sector or business, that's where performance really comes through. So very simplistically put, buying a business at the right price and time in a particular cycle is the hallmark of value investing for us. Most people believe that value investing only reflects around buying something very cheap. So, we very commonly talk about only buying companies below book value or only buying companies which have a very low P. But I think a lot of times that leads us to actually invest in subpar franchises, subpar businesses, what we, commonly call value traps. So I think the other aspect to remember about value investing is to avoid as many value traps as you possibly can, right? So as long as you're getting into businesses where market saturation has not arrived, where obsolescence is not a worry, where governance is not a worry, in all probability, if you get into a business which is not impacted by these three factors, over a period of time, performance should track how the company grows over a longish period of time.
Okay, buy at the right price. That's your philosophy. And those are the kind of businesses that you look for as well. Mr. Pinto, you've always spoken about how value and price matter. This is something that you told us right now as well. So value funds, is this something that you are recommending to your clients at this juncture as well?
Yeah, so to us, value or contra, as one commonly calls the strategy, is evergreen, right? It really is about buying businesses that today probably are out of flavor or distressed, but over long periods of time, we believe that there is substantial earnings growth potential in all these companies, right? So for us, that is very important. The second aspect is that a lot of people try and classify companies as only growth companies or only value companies or only quality companies. We don't really put too much emphasis on that. So we believe that when you buy a business, the price you pay for that business is very, very relevant. So, it's very unlikely that you're going to get an FMCG business at the same valuation of a commodity, business such as steel or energy for that matter, right? So for us, whatever business you buy, the price you pay is very, very relevant. The cycle at when you buy that business is very, very relevant. And to us, that is really the key to generating alpha from a strategy like this.
Okay, I think this is a very important, conversation, especially at a time like this when you are seeing pockets of the market perhaps really surging and pockets which are holding back. Daylynn, if we've already spoken about value funds, but take us through growth funds as well. And what are some key factors which really differentiate both of these kinds of investing? That's value funds versus growth funds.
Sure. So I think value and growth are both strategies that different sets of investors have looked at for a long time, and we really don't believe there is any right or wrong with any of these two strategies. In fact, both strategies actually, whether it's value or growth, try and look for or try to invest in businesses where the investors believe that the current market value is lower than the intrinsic value of those businesses, right? So whether you look at value or growth, I think the end goal is really the same. But I think for growth stocks and investors that really look at growth stocks, I think those investors believe that the overall earnings growth potential of that company is probably going to be much higher than the market and their peers for a longer time to come. And that usually means that with growth stocks and growth companies, the current narrative is very strong. Multiples are usually higher on average than what you otherwise would see. And the current earnings performance, earnings delivery, and forward commentary usually are all very robust, right? So growth investing is really about being right now, looking at what's happening and following those those companies on their journey. As far as value investing is concerned, or value stocks are concerned, I think there the investors are more looking at underappreciated companies relative to what their long-term earnings potential is. And that would obviously mean that near-term narrative is usually weak. Multiples of these companies are usually at average or below average, below long-term average levels. And to us, therein lies the opportunity. So both styles are very different. Both styles obviously have the same end goal, and that's creating, shareholder value or alpha generation. And both styles work probably maybe to sometimes in different market cycles, right? Many a times we also see value becoming growth and growth becoming value. I think that is something that is fairly interesting. If you take a step back and look probably 10 to 15 years ago, chemicals as a sector, to my mind, was thought of a commodity type of business, usually traded at very low multiples. 15 years have gone by, and today chemicals as a sector is probably treated as a growth sector by the market, right? So a very good example of how value has kind of now become growth, and for a variety of reasons, right? Similarly, maybe 15 years ago, sectors like, oil, or sectors like lead acid batteries, for example, which are used in the automotive industry, have derated substantially. And really from what was once thought to be growth-oriented sectors have now kind of become value-oriented sectors, right? With the onset of electrification and the worry that some of these technologies will become obsolete or will not be required any longer. So these are constant debates, and that's what makes investing fun and investing interesting. But both styles have their pros and cons, in my opinion.
Okay, that's also what makes markets interesting, right? It's all relative. So, of course, if one theme is doing well, the other won't, and vice versa. But let's switch our focus on active fund management, because you've been a supporter of that theme for the longest time. But a lot of active funds now, they've not been able to cross the benchmark returns. How do you look at this style of investing in that case?
So I think, there's always room for active. It's a debate again. I think just like value and growth, active versus passive is something that has been talked about, for a long time. I think especially in the 2018, 19, 20 cycle, it was never louder noise than I've ever seen. To my mind, I think, it really depends on how the portfolios are constructed. One needs to have a reasonable active share. One needs to probably take, some bold calls. And that's really, what active management is all about. Of course, within a certain given set of risk parameters. All funds can't really, outperform at the same time. And therefore, different managers, are comfortable with different strategies. And these strategies outperform at different points of time. So I think that's really how, one should really look at it, rather than, expecting that everyone will outperform at every single point of time. I really don't think that's how investment cycles work.
Oh, absolutely. And which is why we encourage investors to, take a longer time horizon, also stay invested for longer to really reap the benefits of being in the markets. And the other thing is that for large cap funds, there are so many limitations, right? The sector exposure, the stock exposure. So perhaps not a fair comparison there. But Daylynn, the other question I want to ask you is on ELSS funds, right? There were a lot of thoughts that were coming in that, perhaps this would now take a backseat, considering that we have a new tax regime where, you can opt for where there are no deductions as well. What do you make of that? Do you manage any ELSS funds? And do you think that there's been some kind of waning of momentum in terms of the flows there? I do know that there are benefits beyond tax saving, but, take us through everything.
Yeah. So yes, we do have an ELSS fund as well. But keeping the new taxation, aside, I think ELSS has all the advantages that other diversified funds also offer. And we always talk about wealth creation being a 5-year cycle, if not more. So from our perspective, I think ELSS, should just be viewed as just another diversified fund by an investor. And especially if you're someone who is what I call very trigger happy, in the sense that you don't have the discipline to stay invested, and you sometimes get worried about market volatility, then actually a fund like this is really what kind of would instill discipline in your entire investment in journey as such. So tax benefit or no tax benefit, I don't see any reason why investors should not continue to look at ELSS as a category. I think from a manager's perspective, the good part about ELSS is that money comes in for the long term. Most managers don't need to really worry about short-term flows into their funds or out of their funds. And that really gives us an opportunity also to deploy a lot of this money with a more flexible approach to our market cap weightings, and as well with a more flexible approach to the length of holdings that we would like to have in our portfolio. So that's really how we think about the overall ELSS category and our fund in particular.
Okay, all right. It's an interesting chat. We will continue it as well, but we'll quickly slip into a short break. And on the other side, we'll continue this discussion with Daylynn Pinto on several investing categories. Stay tuned for that.
Welcome back. You're still tuned into MF Corner here on CNBC TV18, and we still have Daylynn Pinto, Senior Fund Manager of Equities at Bandhan AMC, to talk about various different categories that you could look at. Daylynn, mid-cap and small-cap funds have really been seeing money flow in, right? I mean, for the past few months, you've seen money move out of large caps and into these spaces. What are your thoughts on this category? And, for a new investor getting in, take us through some factors they should consider, because, of course, while the potential for returns is higher, there is also a higher risk that comes along with it.
So as the old saying goes, money usually chases performance, and that's these are categories where performance has been very good over the last few years, especially from the COVID lows that we saw. But I think the biggest learning for us from mid and small cap investing is that every 3 to 4 years you do get one shock, right? So you do get one drawdown, anywhere in the range of 15 to 20%, if not more. And that is something that investors today who are still very bullish and are still coming in leaps and bounds into consideration. As long as you're able to withstand that volatility and that correction, I think that this is still an area of the market where alpha will be generated for a long time to come. At the end of the day, I think over our investment journey, we've seen plenty of small caps become mid and mid become large. And that's really, the thesis for owning many of these stocks for the long term, right? That's where real serious wealth creation has happened. So at these market levels, probably the recommendation would be to look at SIP rather than try and be very aggressive in your allocations towards mid and small. Valuations across the market, to my mind, are not very cheap. There could be pockets, there could be some bottom-up opportunities, but I think at the current juncture, better to be a little careful when we think about these categories.
Yes, and that is a helpful advice, right? Because already we have seen such higher levels. To put in all your money in this space could be a little risky, and that advice comes handy in that case. So from that category, let's move to thematic funds. So many of the themes working well in the markets, apart from the entire broader market space as well. Is this a space where one can deploy some money basis the cycle? Is this a complete no-no for somebody who's doing it for the first time?
Well, to my mind, thematic categories are usually part of the non-core allocation for someone. So usually a top-up kind of product. Preferably for savvy investors who can stomach risk, investors who can stomach, sometimes several years of underperformance as well. However, having said that, there have been, a couple of themes that have done well for a long period of time, and I'm talking about at least a 10-year kind of horizon. We've seen very strong performance from themes such as transport and logistics, from BFSI, from IT. So we've seen certain themes that have done well and have withstood market cycles as well. So all in all, not something for investors to really shy away from, but definitely investors need to look at what are these themes that they're investing on. Are they sustainable in the long run, even if they get the near-term cycle wrong? And are they willing to stomach some sort of underperformance when that particular theme or that particular sector goes through a down cycle? And this does really happen every 4 to 5 years. So I think as long as you're able to withstand these, there is absolutely no reason why someone should not look at thematic funds as well.
Okay, got that. That is on thematic funds. Let's now split it up for investors. Say someone is conservative, someone can take a moderate amount of risk, and someone is a high risk taker. What do you think the breakup should look like in terms of portfolio allocation here?
Yeah, so I think firstly, allocations in general are very person specific. So depending on one's risk appetite, depending on one's cash flows, I think individuals will have to take help from their advisors and accordingly allocate. But on a broad-based basis, I think if you're a conservative investor, I think probably looking at categories like balanced advantage or equity savings, I think that's probably more suitable, especially for people who want to try and minimize volatility to the maximum extent possible. For those who are more balanced, who are able to take a reasonable amount of risk, categories like large, flexi, value, I think these are the ones that probably make more sense rather than moving into pure out and out mid and small cap strategies. And of course, for the risk taker, while I still believe even a risk taker should have a balanced approach to investing, probably mid and small allocations can potentially be a little higher if they are able to withstand those drawdowns and that volatility that mid and small cap are generally associated with.
Okay, the next question that I'm going to ask you, and I'm sure you must have gotten it a lot in last couple of days, is because we got a slew of data, be it the Fed rate pause that came by, but an indication that there could be further hikes, be it the RBI rate policy. And now we are very close to record high, just flirting with those levels. SIP is still the way for investors?
I think so. I think when markets are at average or above average valuations, I think the smarter thing to do is to come in through an SIP STP sort of route. I think one-time investing or very aggressive allocations to equity should be done when markets are at average or below average multiples. So given where we are today and in the context of what's happening both globally and domestically, my advice would still be to go through the SIP STP route at the current juncture.
All right, we got that. That is very helpful advice, Daylynn. Thanks a lot for taking us through all of these various different sectors that we can look at, and how the investment approach can really be different when you look at a value style or a growth style. So I'm sure that will help all of our viewers a great deal. Thank you for joining us on the show today. Sonal, interesting, right, to discuss all of these and how things also change when you're at different cycles of the market. Like he was pointing out, when you are at these all-time high kinds of levels, maybe you should hold back a little, go the SIP route rather than just going in all at once.
Oh, yes. And that idea of how to approach different categories, how to maybe approach active funds or passive funds or value versus growth as well. That was a great example. So, yes, with that, we'll do one thing. We'll take your leave on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.